I'm Taylor Riggs, and for Emily Chang in San Francisco, this is Bloomberg Technology. Coming up in the next hour, the beat is on. Apple's fourth quarter results beat across the board despite sputtering iPhone sales. And for Facebook's third quarter profit and sales top estimates, we have complete coverage. Plus, Polita ban. Twitter CEO Jack Dorsey is doing what Mark Zuckerberg would not. No, he's not banning politicians from lying in ads. Twitter is banning political ads of all types. We have details. And Silicon Valley's conscience, Google's former design ethics. Tristan Harris talks to Bloomberg from the Sooner Than You Think event in New York. His thoughts on technology, humanity, and AI. But first, to our top story. So Apple shares are rising in late trading after reporting its fourth quarter earnings. Apple has beat across the board, topping estimates for both last quarter's results and next quarter's forecast. This is a significant accomplishment for Apple, despite some sputtering iPhone sales. To break down the report, I'm joined by Forrester analyst Julie Osk. Also with us in New York, SMI CEO and founder Lee Drogan. Lee, let me start with you. Broad-based beat. What is your takeaway from this?
Yeah, look, we had been seeing upward revisions to basically all of the numbers throughout the quarter, so it's not a surprise that the stock had performed pretty well coming into the report. That said, especially on the services side, this was a really large beat. That and the gross margins number were very unexpected. And then obviously the guidance for the holiday quarter was very good. Now, I want to put that in context, though, because when you look at the iPhone numbers and when you look at the expected revenue numbers, the midpoint of that guidance number for the holiday quarter is about $5 billion below the all-time high, which was last year. So in terms of Apple's business, they're going to be a smaller business. The financialization, though, of the business itself has led to higher EPS and higher stock price.
Julie, as we know, the company, 52% of the revenue still comes from the iPhone. So it does still all come down to those iPhone sales. I'm showing a chart here in my terminal at GTV Go talking about the average sale price. As they've lowered that, actually, the number of phones are slowly starting to pick up. How much of this demand are you seeing, particularly perhaps around the iPhone 11?
Yeah, so I think certainly, lowering the prices can either bring more consumers into the market or it can speed up replacement cycles. As the phones have gotten more expensive and certainly they rival and sometimes are higher priced than even laptops that are in the market, consumers have slowed down. If we were to look back 5-6 years ago, the replacement cycle was much closer to 2 years, and now it's up beyond that.
Lee, did we see in this quarter people replace their older phones faster than we thought? And is that also what's driving next quarter's forecast for iPhone sales as well?
It doesn't look like that, actually. I think Julie's got it here, that replacement cycle is expanding. And I think, look, myself and my wife are good examples here where, I have the 10 and she's got the 7, and neither of us upgraded this year because we're looking forward to something new, something that's actually a game changer in terms of the hardware. And there's really nothing there. Now, the next cycle looks like we're going to get 5G, and that's where both of us will obviously upgrade, and I think you will see that upgrade cycle tick up again. I think the market basically baked this in, that you're going to get, a lower upgrade cycle. The other issue is that out in China, that upgrade cycle is also slowing significantly because they're working off of comps from the last year where that upgrade cycle was very high when Apple didn't really have a large phone to sell into China than it did, and now we're on the back end of those tough comps. So it's going to take a little while for that to kind of burn off, and then again, that 5G upgrade cycle you might see pick up again.
And Julie, we were talking a little bit before the show, and as we want to focus on iPhone, more and more we just want to talk about services as well, because that is the higher margin business of the company. I'm showing another chart here in my terminal showing the growth of that services business, which is rebounded up 18% here. How much of that services business do you see really pushing growth going forward for the company?
Yeah, so I think it's absolutely essential to Apple as we look forward. On one hand, they've got more services in the market with bringing the TV service and the arcade service in. And if you were to look at somebody opting in to buy all of their subscription services, you could be up over $500 a month per consumer on an annualized basis. And services, because they are subscription, tend to be stickier. I think the other advantage that Apple has here in the market is they have a lot of billing relationships and do have billing relationships with almost all of their customers, and that also just makes it easier to convert customers and to keep them.
Lee, do you need to see Apple sooner transition more of their revenue to stable services from cyclical iPhones? When does that happen?
Yeah, so we've discussed this. Well, it's got to be a year and a half, 2 years now ongoing, and I think the conversation always is built around, well, why doesn't Apple get a higher multiple? Because more of its revenue is trending towards services, and here's my problem with that, is that the services revenue really is dependent on the hardware revenue, and so if people leave the hardware platforms, that services revenue is going to evaporate. So I think the question itself may not necessarily matter in the sense that it's one really leads to the other, and that's why they're not going to get the higher multiple. And yes, it's great that they have more services revenue, but if for some reason a competitor comes in the next cycle or two and puts out a piece of hardware that really blows the iPhone out of the water, I think they're going to have problems either way, whether the services revenue is a lot or a little relative, to that hardware revenue at that point.
And we are hearing Tim Cook on the call coming out and saying that he was calling for a 9% decline in the iPhone, and that's an improvement over a 15% decline in the prior quarter, and that the iPhone 11 is their best-selling iPhones. We will continue to bring you those Tim Cook headlines as they come. Forrester analyst Julie Oss, thank you for joining, and Lee Drogan of Estimize founder and CEO, you are sticking with me.
Thank you.
Now, Twitter has announced that it is banning political advertising from its platform globally. In a tweet on Wednesday, CEO Jack Dorsey said, quote, "We believe political message reach should be earned, not bought." The new policy will go into effect on November 22nd. Joining us for all the details, it is Bloomberg Technology's Kurt Wagner. Kurt, why this decision?
I think the timing is unique in that Facebook literally announced earnings at the exact same time, and here Twitter is basically rolling out a policy that is very counter to the one that Facebook had. I mean, listen, we've been talking about this a lot over the last couple months, which is what are these companies going to do heading into 2020? Are they going to allow politicians to essentially pay to promote falsehoods on their platform? And Jack Dorsey kind of hinted at this last week during an interview where he said he didn't necessarily agree with the stance that Mark Zuckerberg had been taking. And here he is kind of, making the official statement today that they are not going to be the ones to let people pay to promote lies.
I do like that you brought up how notable it was, because the headline in that tweet came out right as Facebook was reporting their earnings. That is not a coincidence, right?
I imagine not, no. And because this policy is so starkly different than the one that Facebook has, it was a pretty opportune time for them to not only, make a splash and kind of announce this, but also do it at the time when everyone was paying attention to what Facebook was going to be doing with their earnings. So I don't think that this was necessarily coincidental.
Kurt, I want to talk about Twitter's business a little bit. You heard Mark Zuckerberg come out and say that political ads were not a big important portion of their revenue, not a big portion of their business. Do we have any indication of how much political ads contribute to Twitter's revenue?
We do. Actually, we just heard from Twitter executives a week ago on their own earnings call, and they said that during the 2018 midterms, they brought in about $3 million in revenue from political ads. So that is a very, very small percentage, pretty much non-existent part of Twitter's business, And so it's kind of an easy thing for them to do. Not only are they taking a stand, Jack Dorsey obviously believes this is kind of a moral or symbolic stand about free speech, but it's also not really going to hurt them at all financially. So it's a pretty easy decision when you think about it that way.
Well, not hurting them financially. So then how does this help or hurt their overall appearance with regulators? Because Twitter really had been staying out of the eyes of regulators. So coming out with this, what does this change in the eye of regulators?
I don't know if it changes as much at all for Twitter, because as you pointed out, they weren't really part of a lot of these discussions. What it might do, though, is it might apply some extra pressure to Facebook, because now all of a sudden you have one of their chief rivals when it comes to not only advertising, but just kind of these free speech debates coming out and taking a very different stance. All of a sudden people might say, well, hey, if Twitter is willing to do this, or if it's going to work on Twitter, why can't it work on Facebook? So I do think that this provides a little extra pressure, another kind of weapon for those politicians who think Facebook's policy is wrong. But I don't think it's going to dramatically impact Twitter, because as you pointed out, this hasn't really been one of their major issues lately around regulation.
Bloomberg Technology's Kurt Wagner, thank you for joining. And coming up, it may still be taking heat for its political ads policy, but Facebook is still feeling the love from Wall Street as user growth remains strong for the social network. We break down the third quarter results. That's next. And if you like Bloomberg News, check us out on the radio. You can listen on the Bloomberg app, Bloomberg.com, and in the U.S. on Sirius XM. This is Bloomberg. Well, it looks like regulatory challenges and political ad criticisms cannot stop Facebook. The social network's third quarter sales rose to a better than expected 29%. Facebook also added about 35 million new users, with monthly active app users reaching 2.45 billion, and that was matching estimates. For more in Seattle, it is eMarketer analyst Deborah Aho Williamson, and still with me, it's Estimize CEO and founder Lee Drogan. Debbie, I want to start with you because we are hearing on the call from Mark Zuckerberg now, frankly, taking on Jack Dorsey of Twitter and taking on this issue of political ads. He says that he is opening up the call. He wants to talk about principles, and that while it doesn't, impact his business, all of this controversy is creating a lot of these headline risks, so to speak. Even though political ads don't make up a big portion of Facebook's business, I wonder how much of these headlines are actually really starting to distract the company.
Mm-hmm. Yeah, that's one of the things that I was feeling very strongly about coming out of the past week's news about political advertising on Facebook. This is taking a lot of attention away from running the core business. This is like taking a lot of mind share away from for the major executives to have to defend their practices. This is clearly something that, even though it doesn't account for a lot of Facebook's ad revenue, is counting for a lot of mind share across the company, and that is concerning to me.
And Lee, your take, given how notable this has been in the analyst call, so before we dig into the numbers, your take on political ads and sort of the outsized influence this is having on the company, especially from the regulator standpoint.
Yeah, so I believe the political ads are about 0.8% of their revenue. And I think the bigger thing here is less that revenue, which, look, personally, I think it would make sense for Zuck to throw that by the wayside, as you can see Jack is over at Twitter. Although the interesting part about the subtweet that Jack is basically making of Zuck here is that you can't really target people on Twitter as well as you can target them on Facebook. So there's an interesting dichotomy there. But at the end of the day, I think what's a little bit more interesting is actually that we haven't actually seen a hit to the bottom line that Zuck had kind of, alluded to, associated with the spending that he was going to do to secure the platform. And there was all sorts of worry from the analyst community and on the buy side that the business itself of Facebook would be encumbered by all the money that they had to spend, but that hasn't really materialized at the end of the day. And the business is still on fire here. I mean, they're pushing just as much to the bottom line as they basically ever have been. And the user numbers continue to be good. They did miss our ARPU number on the Estimize platform by a little bit, which was a little strange given that the revenue number was such a big beat. So that's something that we'll watch out for. But Instagram is on fire here. And at the end of the day, it would just make a lot of sense for him to throw that by the wayside and move on.
Well, he is coming out and saying that if our goal was to make either side happy, I'm pretty sure we're doing a bad job because everyone is frustrated with us. That might be the quote of the day from Mr. Mark Zuckerberg. So, Deborah, let me bring you back in here because we fold in the political ads into the fundamentals of the business. You had a beat on the margins, on the operating income, and a beat on the bottom line. Are they really doing enough to spend to clean up that platform? And if they were, shouldn't those margins come in a little bit lower?
Yeah, you know what? It's in one hand, you could say Facebook could never spend enough to clean up its platform. There's clearly a lot of cleanup to do, and there's no question that it is spending a lot of money. The more it can throw at this, I think the better. But at the same time, the revenue it continues to rise. The user base continues to rise. These are issues that Facebook hasn't had to worry about for several quarters now. They're the more boring stories, quite frankly, about a company like Facebook. I mean, you think of some companies and you worry that revenue or user growth isn't going to match up, and that's the big story going into earnings. But here, the big story isn't revenue or earning or user growth. It's these other big overhanging issues. And I agree. I think the more that Facebook could spend and the more that it can say that to appease the many critics it has, the better it's going to be over time. But for now, the revenue and the user growth is looking just fine.
Lee, of all the good things, sometimes what is news is what is not said. And notably, Libra has not been talked about on the call yet so far. Is that news in and of itself because we're not talking about it?
Yeah, like this thing feels a bit dead. I'd never want to go on the record and say it's completely dead because, who knows what happens in the future. But I think the interesting thing with this is that when we look at the past for Facebook, it is their ability to basically lock people in with different aspects of identity that has kept them on the platform. So single sign-on was such a massive thing for Facebook, and I think Zuck's strategic approach here with Libra was, again, if you can lock them into this currency, you can keep them, you can keep their identity and keep them in all of your, in all of your platforms and keep all of the data, the personal data flowing to the marketing machine. And so I think when we look out 2, 3, 4 years, that was a big strategic driver. I don't think anybody really discounted it into the price, but if you look out, again, 2, 3, 4 years, where is the growth continuing to come from? They're going to have to find another acquisition or another something to keep people kind of, in the walled garden. And this doesn't seem to be what it's going to be. And they would be talking about it more, I think, if they really felt like it was going to be the future.
Well, like we've been saying, a clean beat across the board on both the top, the middle, and the bottom line for Facebook. That was Deborah Aho-Williamson of eMarketer. Thank you for joining. And Lee Drogan, Estimize founder and CEO, you will be continuing to stick with me. And coming up, we take a look back at how the FAANGs fared this quarter. From Facebook to Google, we break down all of the results. That's next. This is Bloomberg. Facebook, Apple, Amazon, Google, Netflix, the FAANGs have all reported, and those reports are in for the quarter. And that means it is time to take a look back and hear what excited Estimize CEO and founder Lee Drogan in the world of the FAANGs. Lee, who is your standout performer this quarter?
Look, I think Facebook continues to just put up incredible numbers against a background, a cacophony of all sorts of stuff in the media that they're dealing with, and rightfully so. But that's a great report there. Netflix was a bit of a disappointment. I think they're kind of a little bit tapped out here a bit on user growth and coming up against a lot of competition. But yeah, again, I think Facebook really stands out here.
Netflix was rising, Lee, today. They're up as much as 4% at one point because AT&T's HBO Max service came out with pricing at $15 a month, which is the first time now that we've seen pricing above Netflix. A lot of the other competitors had come in and undercut them. How big of a headwind remains competition in your eyes? Yeah,
it's just saturation here. I do think that these platforms will be able to raise pricing. The question is, with so many of them in the market, at what point, do consumers, or at what point are they just tapped out, and at what point can you not put another one of them into the market? So I'm not really concerned about pricing, and I don't love the fact that they push the stock up on the comp for HBO. I don't think that makes so much sense because at the end of the day, I just don't know how much more runway there's going to be domestically for for Netflix. I do think the international growth for Netflix is still totally on the board. Those numbers still look like they're moving very much in the right direction, and I think they've got a very big TAM to go after.
Lee, we spoke with Scott Minerd over at Guggenheim earlier today, asked him about unicorns. Take a listen to what he had to say.
The cracks are forming in the dam. So it's hard to know exactly when the dam is going to give, but we definitely have the signs of the erosion at this point. And, there might be yet another last hurrah for the unicorns, but I think prudent money would stay away.
Can you confirm as well that you see cracks in the unicorn market?
So I don't look at it as a monolithic, type thing here. I think there are a set of companies that represented a specific kind of aspect of venture funding and late-stage venture funding, and all sorts of shenanigans that were going on with pricing there. And then there are a set of companies that totally, absolutely deserve their valuations. I think Airbnb is going to come public here and absolutely deserves every dollar of its valuation based on both the fundamentals and how it's raised money in the past. And then there are the companies like Uber and Lyft and what happened to WeWork and all of the food delivery companies, and just basically anything where you have humans involved, where these companies have said for so long that the margins just don't matter and they're just going straight after growth and we'll figure it out later. That's basically done here. And I do think that WeWork was a seminal moment for that. Now, obviously, that wasn't a part of that kind of human delivery or paying humans less than you probably should trend. But in a sense, the capital raising was of the same ilk. And I'm really scared for this Uber report here. I think it's going to be real rough. The Lyft report wasn't terrible today, but you saw the market take that stock down. The Grubhub report was awful. Their guidance was awful. I think it's so interesting what they did with the letter that they put out, where they basically lit themselves on fire to spite the rest of their industry, and for good cause. They're in the right there, basically saying none of us have good business models here, but we have the best one amongst the bad. And I think that that's kind of the case across the board for a lot of these companies. So frankly, I wouldn't touch them with a 10-foot pole.
Lee, quickly here, about 20 seconds. Are we appropriately pricing these stocks, or should we see a bigger regulatory discount overhang on these companies?
Oh, yeah. The California thing is going to be really interesting here with the ballot initiative. So definitely, keep an eye on that. I don't think that's the main thing that's going to drive this. I think it's a tertiary thing. But I think the general aspect of the fact that we're having the conversation at all regarding the input costs, the human input costs of these businesses, that is the thing.
Yep. STMI CEO Lee Drogan, thank you for joining. And still ahead, more on Apple and Facebook's big beats. And later, we go to Lyft. They're impressing Wall Street, citing rider growth. The ride-hailing company adds it will reach profit by the end of 2021. This is Bloomberg. This is Bloomberg Technology. I'm Taylor Riggs in San Francisco, in for Emily Chang. Now back to the titans of tech. Apple and Facebook both beat analyst estimates when they posted earnings on Wednesday. As for Apple, highlights include sales and profit topping analyst projections. Services revenue also reached a record high. And here's some news. Apple will launch a no-interest iPhone payments on the Apple Card. CEO Tim Cook says he believes that the Apple Card is the most successful launch for a credit card in the U.S. ever. With more, it's Tom Forte, D.A. Davidson, Senior Research Analyst. Tom, we've given you a few minutes to dissect the earnings. Your key takeaway.
Yep, so thanks for having me on, Taylor. The key takeaway is that Apple continues to benefit from low expectations as it transitions away from the iPhone. You talked there about the success of Apple Card and how they're going to leverage Apple Card to offer interest rate free financing for future iPhones. So you look at their financial services efforts, you look at the upcoming content efforts, you look at healthcare. All these things enabling Apple to diversify away from the mature smartphone industry, and you're seeing that in the stock, and it's very good news for the shareholders.
Tom, what do you need to see from this company to take this stock next leg higher? We talk about this as a stock that's up more than 50% for the year. It reached another record high this week. What else do you need to see from this company to prove another bull thesis?
Yep, so it's an excellent question. And now what I'm trying to determine is, for next year's upgrade cycle on the iPhone, what are the expectations on a 5G device? Will investors be looking for a global rollout of a 5G device, or will they only be looking for a regional rollout? Because I think the argument now can be made that over the next 2 years, you have the potential for unit growth in smartphones to return as they start rolling out 5G devices. So I think that that could be the next leg up for the stock as we look for expectations of a 5G device for next fall.
Tom, I'm taking a poll of every analyst on the street, so I pose the same question to you. What % of revenue within the company needs to come from services where you get to a point where you are no longer worried about the highly cyclical iPhone revenue? Is it 30%, 50%?
So the way that I think about it, I guess, is slightly the inverse of what you're talking about, which is if you look at last fiscal year, iPhone sales were 60% of total sales. So what does success look like for Apple from an iPhone standpoint? And I think if that 60% of sales in 5 years can be 33% of sales. So the dominance of one device goes from essentially 2/3 to 1/3, then that would be wild success. So if you invert that and say basically non-iPhone sales go from 40% to 2/3, that would be a different way of perhaps looking at the numbers you're looking at.
Tom, we're hearing on the analyst call right now that wearables are up more than 50% from a year ago. This is according to the CFO. Is wearables automatically assuming that will be a growth driver for the company?
The answer is yes, and really if you think about it, the amazing thing about their success in wearables is that the battery life for a lot of their smartwatches remains limited. And I think the fact that they've been able to do so well with what you would have thought would have been a gating factor to succeeding in wearables, meaning having a watch that doesn't last 24 hours, is very remarkable. But again, I think the data point they provided, Taylor, that was so interesting was 17% sales growth when you adjust for the iPhone. So they do have a fair amount of growth going on if you can set aside, again, the mature iPhone market.
Tom, finally here, I want to come and take a look at a chart that I'm showing for our Bloomberg audience. You know the story. It is total cash, which is still above $200 billion, minus about $100 billion of debt or so, which still leaves you about net cash of $100 billion. Where should the company be using their cash?
So the big story has been returning cash to shareholders both via dividends and via buybacks. But I think what they need to lean into is basically new product and new services to, again, diversify their revenue away from the iPhone. So you're seeing that with more recently kind of a dip in the toe on content where the original expectation was $1 billion of spending and that went to $6 billion in spending. But we'd like to see them lean more heavily into services and devices that aren't iPhones, in addition to returning money to shareholders. And I think this stock will continue to run.
Tom Forte of D.A. Davidson, thank you for joining. And now I want to go back to another second major tech story of the day, and that is Facebook. And CEO Mark Zuckerberg has been remaining defiant on the investor call. Take a listen.
I expect that this is going to be a very tough year. We try to do what we think is right, but we're not going to get everything right. This is complex stuff, and anyone who says that the answers are simple hasn't thought long enough about all the nuances and downstream challenges. Now, I get that some people are going to disagree with our decisions. I get that some people are going to think that these decisions may have a negative impact on things that they really care about. But I don't think anyone can say that we're not doing what we believe or that we haven't thought hard about these issues.
For more, I want to bring in Bloomberg Intelligence Senior Analyst Jitendra Woral. You just got off the call. Were you surprised that he was opening it up, really using a lot of that time defending the political ad situation?
I mean, not surprised at all. It has been a big topic for the last couple of quarters, and it will continue to be so, like going into the election year. But if you look at the business side of things, that's humming well. I mean, they came ahead on every metric there was, including margins where there were some worries. Now, they are projecting a slowdown in 4Q. It might be a little conservative. There are some comparison issues in 4Q with respect to product changes and things like that. But what this quarter is really showing is Facebook is setting up here next year for its newer businesses to diversify beyond advertising. So you're talking about e-commerce, you're talking about payments, and that's what's going to be the story all about from a business standpoint. As far as the regulatory aspect is concerned, I mean, that is going to be an ongoing discussion, debate, argument throughout next year, but the business side is sort of stays untethered.
Are we seeing any cyclicality in their ad revenue around the election cycle? We know that Facebook and Google just continue to dominate the ad space, but are we starting to see any cyclicality there?
It's not that big in terms of their total revenue. So if you look at, say, Facebook or Twitter, the political ads is a very small portion of their business. So not a lot of cyclicality in terms of revenue per se, but there's some organic traffic, more eyeballs that do come along the way. That may help Twitter more so than Facebook, but cyclicality based on elections, or at least on the business side of things, it shouldn't sway the results much.
Not to be a total negative Nancy, but I think there were some concerns that the margins beat because we were looking for a margin miss to see that they were spending money on cleaning up that platform. Are they doing enough to clean up the platform? And
they are accelerating hiring next year. So if you look at their guidance for cost and expenses, $54 to $59 billion for 2020, they usually give a higher guidance early on and then taper it off. But it's basically telling you that the headcount growth will continue to increase. Going into election year, they are being more cautious with these improvements and henceforth. And this is really going to be a moving target over here. This is not a one-quarter fix or a one-year fix, really. This is going to be an evolution of the infrastructure spending and how they allocate personnel. So at least, you know, from a financial standpoint, they are making sure that there's capital and spending allocated or baked into expectations for next year, especially going to election year.
I know that you as an analyst, a bottom-up analyst, really look at the fundamentals. The problem that we're having here with Facebook is it is increasingly becoming a political conversation, a regulatory conversation. So with the Twitter announcement as well that they're going to ban all political ads, we're getting more tweets from the senators. Senator Marsha Blackburn coming out and saying that freedom of speech is paramount to who we are as a nation. The beautiful thing about our country is that Twitter has made the ultimate decision as to what type of content they allow on their platform. I know you don't want to cover all of the politics, Jitendra, but talk to me here a little bit more about this more political backlash that Facebook is getting and their image, frankly, for regulators.
So it's basically two lives that they're living over here. One is this constant battle with regulators, and that's going to be an ongoing topic, really. And the other aspect is the business side, where it's more than 70% of the world's online population is using the service every single month. So that means that, you know, at least from a business standpoint, they do have the advertising strength behind them, and they do have the capacity to actually get into this other businesses like e-commerce and payments. As far as regulations are concerned, we are starting to see some impact over here in terms of, you know, how quickly they can roll out products, you know, what kind of changes they can actually do, how much flexibility that they really have in long-term strategies. That has been kneecapped. So you are seeing that in sort of long-term results, but if they focus on some of the strengths into diversifying the business, especially Instagram checkout, e-commerce, and when I say payments, I don't mean Libra, I actually mean, you know, what they're trying to do with PayPal partnership with Instagram and things like that. So those are the avenues where there is a very big audience on the platform who's willing to transact, and they are making tools available for them. So they'll have to manage these two lives, you know, into next year, and you're going to see these debates getting even hotter next year.
Well, interesting, as we were saying, Libra has not yet come up in the earnings report, so that is notable. notable as well. Jitendra Worrell of Bloomberg Intelligence, thank you for joining. Now, coming up, Lyft shares are up in after-hours trading after also beating analyst estimates on revenue. We will break down the figures and discuss how rival Uber is poised before its earnings. That's next. This is Bloomberg. Ride-hailing company Lyft blew past analyst revenue estimates for the third quarter. Lyft said full-year revenue will now be at least $3.57 billion, beating the projections of about $3.5 billion. Increased ridership and higher revenue per rider drove results, and the company said it will turn a profit in 2021. Shares are rising in after-hours trading, and I go straight to D.A. Davidson analyst Tom White in New York. He does make a market, or D.A. Davidson makes the market in both Lyft and in Uber as well. Tom, what's more impressive, the top line or the bottom line here?
I think you'd have to say the top line trends. As you said, a nice kind of 5% beat on revenue, and it was a high quality beat also. They beat on active riders, and they also really benefited and beat on a sharp acceleration in revenue per rider, which was driven by them really optimizing on price, so taking up prices on some consumer fares. It's an initiative they started kind of late in the second quarter on very select kind of targeted routes and in targeted markets. And so the top line beat was quite nice. The EBITDA beat, the headline beat was quite nice. There's a little bit more nuance there, which I think led to the stock. It's trading up now, but it was trading up even a bit more right when the headline numbers came out. But overall, we think a very, very solid quarter from Lyft.
And is a bottom line profit finally by 2021 in line with your estimates of where you want to see the company turn a profit?
Yeah, so they beat us by a few quarters. I think we had them sort of mid-2022 as far as when they generate positive EBITDA. Look, I think, the fact that the management team is confident enough to sort of lay a very precise and specific timeline out for EBITDA profitability underscores a couple of things. One, that the North American ride-sharing market really is benefiting from sort of a rationalization of the competitive intensity that we saw from both Uber and Lyft when both were private companies. As public companies now, they've got shareholders that they've got to answer to. They've got to demonstrate path to profitability, and I think both companies are benefiting from that. And I think in Lyft's case, it also just highlights how it's a lot easier to forecast a business that is one product, is one geographic market, a challenge that unfortunately Uber has a bit more challenging facing them, just given how many markets they're fighting in both Uber Eats and in ride sharing.
Right. So in your latest note, you talk about Lyft's targeted strategy. Why is that better than Uber's strategy of going in a lot of different directions in other lines of business?
Well, I don't know that it's better. When we devise our rating system at Davidson, we generally look at a 12 to 18 month rating or time horizon. And in the case of these two companies, we just feel like the visibility at Lyft is significantly better. In Uber's case, they're fighting in a lot of different geographical areas. All of the markets are at different stages of evolution. You've got far more varied competitive landscape. So, Uber's got a lot more sort of private VC-funded competitors to deal with, and that it has to react to if those competitors get aggressive on the incentive side. So, I wouldn't say that it's better, but, over the next 12 to 18 month horizon, we feel a lot more comfortable recommending investors buy Lyft than Uber.
Well, we will await Uber earnings, of course, on Monday. Thank you so much. That was Tom White of D.A. Davidson. And still ahead, restoring trust in the tech sector. We hear from the former Google design ethicist. He's now the co-founder and executive director of the Center for Humane Technology. It is Tristan Harris. He's next. This is Bloomberg. Distrust in the tech industry has been on the rise in recent years with data privacy breaches, potential user bias, and antitrust probes. At Bloomberg's global technology event, Sooner Than You Think in New York, the so-called conscience of Silicon Valley, that's Tristan Harris, sat down with Bloomberg's Caroline Hyde, former Google ethicist and now the co-founder and executive director of the Center for Humane Technology. Harris discussed why, despite it all, he remains a tech optimist.
The root problem is attention capitalism, the pairing of profit directly to the incentive to modify or change your behavior, your attitudes, or your beliefs. Because just those slight changes in your identity, your attitudes, beliefs is the profit model. And attention capitalism is always demanding to find cheaper and cheaper ways of generating attentional labor out of human vessels. So in the same way that, if you look at, a Bloomberg newsroom, and it's a really expensive way of generating human attention. You got to pay all these journalists, security details to go to Iraq. That's a really expensive thing. What if we get people to trade links with each other that confirm their own worldviews and do that labor for free? We can generate the same amount of human attention that Bloomberg can, but it doesn't cost anyone any money because we can convince the users to do it for free. That's attention capitalism. It's finding cheaper ways to dupe us into playing the fame lottery and sharing links with each other to generate human attention for a system that basically hollows out our media environment and our sense-making environment, which has been poisoning our democratic sort of information system. It's almost like the Flint water supply for our brains. And in addition to attention capitalism, the next stage of it has been to use algorithms, because they're cheaper, to choose what to show us than to pay human editors to use moral judgment about what's true or worth our time. It's expensive to pay all those people to review all that stuff, so let's just use algorithms. But the problem is, if you let YouTube shape what 2 billion people, more than the size of Christianity, look at every day for more than 60 minutes a day, we know that on a spectrum from calm Walter Cronkite version of YouTube to crazy town UFOs, if I'm YouTube and you land somewhere on YouTube, if I want you to watch more because of attention capitalism, I'm never going to send you to the calm side. I'm always going to send you to crazy town, which means that it tilts the entire social fabric towards the crazier stuff. And YouTube has been recommending Alex Jones conspiracy theories, anti-vaccine, flat earth, hundreds of millions of times. And this has been poisoning our information environment, including with climate change, because climate denial videos have been recommended hundreds of millions of times. It's more than 50%, about 50% of the videos recommended about climate change are denial videos. So when you really take into account that this is the new information system that we're feeding everybody, because it's controlling more and more of our informational sense-making lives, it's really not good. And until we change the incentives, we have to actually start paying for a world we want to live in, because free is the most expensive business model we've ever created.
So is the answer regulation? Because it already feels like the public tide is turning to a certain extent. The businesses themselves have realized some of the limitations within their business models. They're starting to try and employ more fact checkers, add humans back in. They're trying to ensure that perhaps YouTube for kids is a safe space.
Right.
There's been change made. Is it enough, and what will accelerate the change?
It's a great question. So YouTube so Facebook and YouTube have both upped the number of content moderators that they've hired. Facebook has 35,000 content moderators. But if you look at it as a percentage of their budget, I was just in Los Angeles. So if you're in Los Angeles, how much do you think a city like LA spends on security and policing? It's 25% of their budget. Facebook's budget, it's only 6.7% of their budget. So you could say that's because of efficiencies, but no, they've got 35,000 content moderators for 2.7 billion users. As we talked about on stage, they just recently took down 2.2 billion fake users, fake accounts, in just the last 3 months. So if you think, if they could take down 2.2 billion fake accounts, that's how much fraud is going through the system.
But you're a technologist. Do you not think AI, machine learning should make it more efficient?
It does make certain things more efficient, but AI can't tell us what's true. And it can't discern between journalistic value and damaging speech. It doesn't have these ways of moral reasoning. And so the trap we've put ourselves in is that attention capitalism has now anchored us on an expectation that we can generate these forms of attentional labor for this low of a cost, while we've been poisoning our information environment and poisoning the children's mental health, which we didn't talk about, because teen depression symptoms have gone up 170% in the last 6 years after 2 decades in decline. And so when you really take into account that this business model has had a huge cost, so just like with climate change, we're profiting with growth, we're fueling our growth off of the creation of more harm, more risk in climate change. With this, we're profiting and creating more technological growth off of the poisoning of our own children's minds, off of the poisoning of our democracy. So we really have to decouple. It's very much like climate change. We have to decouple the harm from the good.
And there is good still there. Are you inherently a technology optimist or pessimist? Because it feels sometimes we're outweighed by
the pessimism.
The pessimism in technology, where there's been a huge force for good.
Absolutely. Look, I believe in a world where Facebook could just be about finding out when your friends are in the same city as you and getting to see them on those nights. I believe in a world where Facebook is just about helping people find connection when they're feeling lonely, in a world where you can reconnect with those people that you lost track of 20 years ago and creating those rich connections. They can do all of those things, and in fact, they can do it more often if they didn't have a business model that's about commandeering your attention forever. So the point is to actually realign the incentives so that all those engineers behind the screen are working on your team instead of on someone else's team and treating you as a resource.
That was Tristan Harris of the Center for Humane Technology speaking today at Bloomberg's Sooner Than You Think Tech Conference in Brooklyn. And that does it for this edition of Bloomberg Technology. And Bloomberg Technology is live streaming on Twitter. Check us out at Technology and be sure to follow our global breaking news network at TikTok on Twitter. This is Bloomberg.